Previously on the Fundera Ledger. And the reality is, if you look at any company, there are three major financial statements that together really complete the picture. And any picture that leaves out one of these statements is really incomplete. Yes, of course, it goes without saying you have to be profitable and make money, but the balance sheet has more information that represents the accumulation of what happened whether or not you made money. And the statement of cash flows reconciles all this. It takes the net income, it reconciles the activity between the income statement or the profit and loss and the balance sheet. It takes that accrual basis net income and analyzes the activity on the balance sheet to reconcile from net income to cash. Now we're getting somewhere. So look what happens. It says I've got $100,000 in net income, but I haven't received any money yet. It's all in accounts receivable. And you take that plus the $10,000 I contributed, and that's how we wind up with $85,000. So this week we're taking a look at the balance sheet. We're talking about the Small Business Owner's Guide to the Accounting Balance Sheet. Now we sort of went ahead and we did kind of like the advanced math before we got through the geometry. But the reason we did that is because you're probably already somewhat familiar with the balance sheet. Most small business owners focus primarily on the profit and loss, and frankly, in my opinion, a little too much on that statement. And then next most on the balance sheet. Should be the other way around. And then the statement of cash flows, as you no doubt saw. If you didn't check, we'll post a link and you can click over and catch up from that one. Because at the end of the day, that kind of ties it all together as I laid out for you. So now I want to take a little bit of a deep dive into the balance sheet and go over that with you. You should read the write-up because the write-up gives you a lot of detailed information that's going to give you context for what I'm talking about here and also what I'm going to demonstrate for you right here in QuickBooks Online on my screen. In another 60 seconds or so, we'll get started. However, let me just lay it out for you. The balance sheet is broken up into three sections, essentially, not essentially, it's three sections: assets, liabilities, and equity. It answers one fundamental question, and to me this is the right question. Too many small business owners come and ask me, how much money did I make? And I respond to them by saying, you're asking me the wrong question. The right question should be what the balance sheet tells you at the very bottom, which is the answer to the question, what is my company worth? That's the question you should be asking. Because as I point out in the write-up, you can earn $1 million, spend $1.5 million, and your company's got negative equity, right? Your company's actually got negative net worth. That's not good. If you want to get a loan from a bank, if you want somebody to perhaps buy your company someday, then the strategy needs to be to grow the equity section of your balance sheet. And I'm going to show you by illustrating through transactions that I'll post exactly how you increase the equity of a business and what the best way is and what the not so best way is, for lack of a better way to put it. When you ask me how much money you made, one of the other reasons I tell you that you're asking the wrong question, maybe what I should also say is you're asking that question too soon. The first question needs to be, how accurate is my balance sheet? And that's another thing I went over in detail in the write-up. There's 5 management assertions that you're essentially presenting when you present financial statements to a bank or a potential investor or buyer. Anybody that you might need to present financial statements to, there's implications that you're sort of making, whether you know it or not. You're telling them that the financial statements are accurate, that all the transactions are recorded and error-free. You're telling them that everything's classified correctly, that it's complete, everything that should be there is, that the cutoffs are right, that things are recorded in the right periods, and that the occurrence is actually accurate, that these transactions really did occur. So if I just look at a profit and loss, and this is one of the things I'm going to illustrate very specifically, it can be very misleading. I can show a company that looks like it's really profitable, but has zero net worth, so that if somebody was, again, assessing you for creditworthiness or otherwise, if they only looked at the P&L, it could be misleading. But obviously, they're going to be smart enough to know to ask for the balance sheet and the statement of cash flows, and that's where the picture gets completed. So a company like what I just described would never be able to qualify for a loan because they look at what I'm going to show you in this example in a second, and they would see that it's not likely you're going to be able to repay the money if, for example, you're pulling all the profits out of the business. Let's take a look at my screen and see what this looks like. So we're back in my same company from last week's video on cash flow, on the statement of cash flows, but I gutted it out. I took out all the transactions so we can start all over. In fact, we're going to start with the transaction that I had in there last week, but I never actually showed you how I recorded it, which is where we finance the business. We start a brand new company from zero and we finance it with $10,000. So I'm going to stay on this balance sheet. Let's just run it. Oops, I clicked on the wrong thing. Let's run this for all dates so you know that there's no tricks up my sleeves. There's nothing in here. Let's record a deposit. and we're going to say it was received from me, Seth David. The owners I set up as customers. In a future video, I'll explain to you why that is. But for now, take my word for it. Set up owners or investors in your company, people who would have contributed capital into the equity part of your balance sheet, should be set up as customers. Now, notice what I've got here. I've got an account called Shareholder Capital. It's an equity account. And I've got two sub-accounts, one for shareholder contributions and one for distributions. You're going to see by the end of this video how clean and nice this makes it. It becomes very clear what I've put in, what I've taken out, and what that all adds up to. So we're opening up our bank account with $10,000. We'll say we did it on the first business day of the year, January 3rd. And I'll say save and close. Yes. Now what I've just done is I've contributed value into the business. And let's again go back to all dates from my balance sheet. I put $10,000 into the business, so that shows up as an asset, right? I own that money. It's mine. I have rights to it. What I also did was I increased the value of the business because I put $10,000 in. So that shows up down here also in the equity section. And notice how our balance sheet balances. My total liabilities and equity add up to $10,000, and my total assets are $10,000. Again, notice the structure, right? I have shareholder capital Seth David and shareholder contributions $10,000. It's very clear this is money that I've contributed into the business. If I put cash into the business, if I finance the business with $10,000, I increase the equity. So that's one way to increase the equity of your business, is to finance it, to put your own money into the business. But as you saw, if you look back at last week's video on the statement of cash flows, that can only sustain itself for so long, right? I can only keep putting my own money into the business for a set amount of time before which I'll have to close the business. In other words, ultimately, the cash flows need to come from operations, not from financing activities, and that's what we laid out in the statement of cash flows. That's why it's also good that you hopefully saw that before you got to this video. Now, let's look at the best way to add equity into the business, and that goes from earning profits, right? From actually running the business, in a profit position. So let's go record an invoice. We'll do it just like we did last time, except we'll just do the whole entire $100,000 in a single transaction. We'll do a design fee, $100,000. Now watch what's going to happen on the balance sheet when I save this. So again, let's run it for all dates, run the report. We've increased our accounts receivable because, again, we haven't gotten paid, we just earned the money, right? Presumably we've provided the service, $100,000 in value, and we've invoiced the customer. They now owe us $100,000. I'm not going to run the profit and loss because it's pretty clear. If I have no other transactions on the books, which I don't, then all that it's going to show is income of $100,000, no expenses, net income also $100,000. So at this point, I've got a $100,000 profit on this business. And that closes out to the equity section of the balance sheet. When I earn a profit, it increases the equity of my balance sheet. So that closes out, and that's how I balance. Notice I have the accounts receivable plus the cash is $110,000 in total assets. I have the $10,000 I contributed plus the net income closing out to the equity, the net profit that I earned for the period, also closing out to the balance sheet, also adding up to $110,000. Now, this is the right way, the way that you want to be increasing. I shouldn't say the right way. There's nothing wrong with contributing money and financing the business, but ultimately this is the way you need to be increasing the equity of a business, is increasing the equity by earning a profit, right? So if we keep doing that, business is going to be really nice and healthy. And as a strategy, I want to impress upon you as a small business owner that, yes, it goes without saying I have to make a profit. You can see clearly why here. But beyond that, the strategy should almost be more focused, in my opinion, on growing the equity section of your balance sheet. If I were to graph your equity over a timeline, I'd want to see that steadily increasing. That's a sign of a really healthy company. That's a sign of a company who, when I look at their statement of cash flows, will clearly show that they're deriving most of their cash flows from operating activities, if not all of them. Now, here's where a lot of business owners make a mistake, especially small business owners, because they don't focus on a strategy like that, because you're not even thinking like that, because until today, perhaps, nobody's told you to think like that, and you're not accountants, and we get that. Now, let's look at what business owners often do, which is a mistake. So they get all this money. First of all, we need to get paid, right? Before I do this, let's go get paid. So let's go receive payment. Some customer and we'll get paid the whole amount. And we're going to deposit straight into the operating account, save and close. And it keeps resetting my balance sheet to last month. Let's run that. Now look what happened. We've basically converted an asset from accounts receivable to cash, right? So we took what's generally considered to be a fairly liquid asset and made it into the most liquid asset. We converted receivables to cash. Total assets doesn't change, still 110,000, because we just moved money around the balance sheet essentially. Down below, we now have the same 10,000 we contributed, the same 100,000 we earned in net income, the same total equity, 110,000. Everything balances. Now here's where a lot of business owners make a mistake, and I'm going to put it in the extreme, obviously for purposes of illustration, as we say, woohoo, we just got paid $100,000, we have all this money, let's take it out. So I'm going to write myself a check, and here's where it goes to shareholder distributions, right? Because I'm taking the money out, I'm taking a distribution out of my corporation. Let's take out the whole 110,000. And what do you think this is going to do to the balance sheet? When I save and close and we go back to the balance sheet, what happens when I take out a distribution is I'm not getting the benefit of an expense, so I'm not getting a deduction which would lower my net income and therefore my tax liability for the year. I'm sucking equity straight out of the business. I'm draining the business, literally draining the lifeblood of the business, taking out its cash and taking out in the form of an equity distribution. And look what happens to my balance sheet. Let me go back to all dates, run report. I wrote the check out of the wrong account. Let me fix that. I don't know why that happened. It should have remembered the bank account from before. But let's change that to Wells Fargo operating. Back to the balance sheet. And now we're good, all dates. So we've now drained all the cash. There's no money left in the business. Can't pay for anything. We originally contributed 10, but we've now taken out 110. So our net shareholder capital is negative 100,000. We earned 100,000 in income. That's how we're able to take that much out, that much more than what we contributed. And now our business net value or book value or net worth of our business is a big fat zero, right? So this is obviously going to paint an interesting picture, because now if I duplicate this tab for a minute, and while that's updating, let's go to reports and let's run a profit and loss, and realize, of course, that in a real situation there would be a little bit more detail than this, but in concept this is exactly the kind of thing that can happen. I can show somebody, based on this scenario, a profit and loss where I say, look at this, I made $100,000 my first month in business. Isn't that amazing? And then the savvy loan officer at the bank or person who's looking to possibly invest in my company is going to say, that looks amazing, but let's see what the balance sheet looks like, right? And then they look at the balance sheet and they see this and they say, oh no, there's no way I'm investing in this company. Look at this, right? You put in $10,000, you earned $100,000 in the first month, great, but then you pulled all the money out. That's not a sign of a business owner who's really working to build and grow the company and reinvest back into that company. That's where we want to see cash outflows coming through the investing activities on the statement of cash flows. And let's wrap up by looking at a statement of cash flows since we learned all about that last week. Let's go to all reports, business overview, over here to statement of cash flows. Let's run this for all dates. And let's see what happened here. Again, we earned net income of $100,000, right? Accounts receivable netted out to zero because we earned it and we got paid the whole amount. So there's no change in accounts receivable. It started at zero and ended at zero, right? We contributed $10,000, but we pulled out $110,000, right? So the net cash provided by financing activities was a net negative $100,000 against our net income that we earned and got paid for $100,000. So of course, cash at the end of the period, zero. Again, this statement paints a very clear picture that shows that we took out everything, right? Now granted, like I said, this is the extreme, but most small business owners, I should say many small business owners, do a much less extreme version of this, because we take out distributions to finance our personal, when really what we should be doing is structure it so that we structure a payroll and pay ourselves payroll out of the, assuming it's a corporation especially, so that we can learn to live off of that money. And that gets us into a whole other kind of financial planning conversation, which I don't have time to do today. But as always, I hope you had some fun and learned something along the way. And if you did or have any questions, comments, feedback, concerns, please don't forget to subscribe on YouTube. And post your comments, whether it's on YouTube if you're watching it there, or directly over on the Fundera Ledger if you're watching this video there. Bottom line, post your comments. Somebody will let me know that you've commented. I'll get back to you as soon as I can with any answers I can provide to any questions that you may have. Again, I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.